I'm Josh Duvall, certified financial planner, chartered tax consultant from Duvall Wealth and Tax Planning. Just want to make a quick video about a conversation I've had with a number of clients as we're looking at summertime tax planning, specifically regarding the investment portion and some ways to utilize backdoor Roth IRA contributions depending on the different circumstances that you might have with other IRAs or retirement plans. So, why would anyone do a backdoor Roth? The reason why you would do a Roth contribution is to get dollars that are post-tax into an account that can grow tax deferred, that can have any investments you want. You don't pay any capital gains tax along the way, so you can trade, you can buy, sell, whatever you want. As long as the money stays inside the Roth IRA, you don't pay taxes on dividends, you don't pay taxes on interest. That's what tax deferred means. The second piece is that once you hit age 59 and a half, the dollars that have grown in the Roth, remember your contributions are always after tax, but the growth has not been taxed. And as long as you follow the rules of the Roth IRA, keep the dollars inside of the IRA until you're age 59 and a half, when you pull them out for retirement, those gains, the dollars that have appreciated in the account that have not been taxed, will be received tax-free upon a legitimate retirement withdrawal. So that's the whole purpose of a Roth. It gives you tax-deferred growth, it gives you tax-free withdrawals in retirement. The issue for a lot of my clients is that they make too much money to directly contribute to a Roth. So a major difference between a traditional IRA and a Roth IRA is that Roth IRAs are bound by income limits. So there is a chart that's released every single year that tracks your modified adjusted gross income, and your income has to fall below a certain number every single year. And again, you can look up the 2026 figure, or if you're watching this in the future, go look up the figure for the year that you're watching. And there was going to be a dollar figure, whether you're married filing jointly or married or single or married filing separately, right? Depending on your tax status, there's going to be an income figure. Once you make that much money, you can't directly contribute to a Roth. So then people say, oh, okay, I'll use a backdoor Roth. I'll contribute to the traditional IRA. Again, anyone at any income level, as long as you have income, can contribute to a traditional IRA on a post-tax basis, meaning it's a non-deductible contribution. Anyone at any income level can do that. Now, if you have a 401k, if you make a certain amount of income, you won't be able to deduct your IRA contribution. But again, we're already assuming that you make too much money in order to do that. So they'll say, okay, let me put money into a traditional IRA and then I'll convert it to a Roth. That sounds great, except if you already have IRA dollars that are pre-tax. That creates a major issue called the pro-rata rule. What that means is the IRS looks at all of your IRA accounts. So this is a SEP IRA, a traditional IRA, a simple IRA, not Roth, and not beneficiary. We'll talk about that in a minute. All of your IRA balances are taken in total, cumulative balance. And then the amount that you convert is based off of the entire percentage of the cost basis of that account. So let me give you an example. Let's say that you have IRAs that total $100,000. Let's make it easy. Let's do $93,000, okay? And then you contribute $7,000 of post-tax money. So your 93 was a old 401k that you rolled over. So it's all pre-tax, has never been taxed. And that $93,000 balance is now added to $7,000 of your contribution. If you're in tax year 2026, it's $7,500. If you're above 50, you get an additional $1,100, so it's $8,600. But again, just for a simple illustration, you have 93, you put in 7 post-tax, and then you say, I'm going to do a conversion. Well, whatever amount you convert, that pro rata percentage, 93 pre-tax, 7% post-tax, is going to be applied to that conversion. So if you were to take, a $10,000 conversion, $9,300 is going to be taxable, $700 is going to be non-tax because it's your post-tax contribution. That percentage, 93 and 7, is applied to the conversion. So the question is, well, how do you solve this? The way that you solve it, and the way that high-income people can still do backdoor Roths, even when they have IRA dollars, is by moving the IRA through a reverse rollover back into a qualified retirement plan. This would be a pre-tax 403b, a 401k, a 457. So you'd be looking at moving those dollars back into a pre-tax retirement plan. Now, again, you have to look at the specifics of the plan that you have. You have to investigate if that plan allows a reverse rollover where the IRA dollars that are entirely pre-tax are moved into the qualified retirement plan at work. And then you have no more dollars in your IRAs. Now you have to make sure that you do this cumulatively. So if you have an IRA at Schwab and an IRA at Fidelity, and you take the IRA at Schwab and you send that back to your 401k, but you forget about the IRA at Fidelity, when you go to do your conversion, that IRA at Fidelity is going to be part of your pro rata rule. So you either need to simplify everything down so that you have one IRA account, or if you have multiples, you need to make sure that all of them are reversed, rolled over back into your 401k or your qualified retirement plan. And again, your plan has to accept this. So you have to check and see, does my work retirement plan accept a reverse rollover from an IRA? They can, but it doesn't necessarily mean that they will. So you have to investigate that, right? So you do have to do a little bit of legwork. And of course, the devil's in the details. You have to understand the plan that you have, if this is feasible for you, if you want to do this. And there might be reasons why you don't want to. But it is a solution for people that are looking to get dollars building up in their Roth. And why does it matter? Well, the reason why it matters is because you want to have tax diversification across these three buckets. Pre-tax 401k, tax deductible IRA stuff. Your pre-tax dollars gives you a benefit in the current year. Your Roth dollars gives you a benefit in retirement. Your brokerage account dollars gives you unlimited flexibility. You can buy and sell whenever you want. You can take dollars whenever you want without being penalized. You can offset losses and gains. You can get dollars out of the account without paying taxes. There's a 0% capital gains bucket. So you could theoretically, in the future, quit working, and before you take Social Security, before you take RMDs from your IRAs or 401ks, you could pull money out and get a significant amount of gain out of your brokerage accounts without paying any tax whatsoever. So you want to have tax diversification. That's why you want to be able to do something like the Backdoor Roth. If you make too much money to directly contribute, and if you have other IRAs, then the way to do it is to do that reverse rollover into your pre-tax company retirement plan. Now you have no money in any of your IRAs. You make your post-tax contribution of whatever amount up to the annual limit, and then you convert it. And once it converts, you don't pay any tax because, again, these were already post-tax dollars. You convert and you invest in the Roth like everything else. You go about your day. You can do that every single year. And that's a strategy that high income folks are using to get backdoor Roth contributions without paying taxes. So if you want to learn more about that, if you want to talk about the specifics of this approach for your specific situation, please feel free to reach out, josh@duvallplanning.com. You can go to the website and book time with me, duvallplanning.com. Again, devil's in the details. You have to look at your specific situation, but there is a way for high-income people with pre-tax IRAs to get around the pro-rata rule. It's through the reverse rollover. So feel free to reach out, josh@duvallplanning.com. Thank you so much. Hope you have a great day. Bye-bye.